Everyone is running from this stock. And, you can't really blame them.
Not when you see the headlines.
Exactly. An 85% year-over-year collapse in operating income, free cash flow down 76%. I mean, it just screams terminal decline.
It does. And those are the numbers that define, for us, the ultimate contrarian signal. Our deep dive shows this isn't failure. It's a controlled maximum capital deployment.
Okay, so let's unpack that. Because to get there, you have to completely reset your view of the company.
You do. The old identity of Alibaba as this stable utility funded by the Chinese middle class is just obsolete.
This is more like a violent mutation. The company is forcing itself to become the architect of AI infrastructure.
Yes. The core retail business isn't the end product anymore. It's just the funding mechanism for this incredibly high-stakes AI war.
It sounds a lot like the Amazon 2016 playbook.
It's a perfect mirror. They intentionally compress their own retail margins to finance the massive CapEx-heavy build-out of AWS. It's like burning the furniture to keep the furnace hot.
A huge claim. So if they're sacrificing today for tomorrow, where is the hard evidence? Where do we see that this pivot is actually translating capital into growth?
The proof is in the cloud intelligence group. The broader Chinese cloud market, it's growing at what? A moderate 21%?
Right.
But our findings show Alibaba Cloud's revenue growth accelerated sharply to 34%. That is the core indicator.
And the mechanism behind that acceleration, this is what we found really interesting. It's the models of service, or MOSS, flywheel.
Right.
They open source their Qwen large language models. Break that down for the listener. What does that mean operationally?
The key is that these models are specifically optimized to run most efficiently for things like inference and fine-tuning only on Alibaba Cloud.
So you're selling the operating system with the hardware.
You are. And that creates a very high-friction technological lock-in for the, over 290,000 corporate users they've already attracted. It makes it really hard to just jump ship.
That's convincing on the cloud side. But what about the funding engine? Is that old retail core stable, or is it, leaking cash?
It's stable. It's not dying. Customer management revenue, which is basically their ad fees, that's stabilized at a reliable 10% growth.
Okay, but what's really crucial is the strategic shift they made.
Exactly. Instead of just relying on volatile ad income, they're now taking a small, very reliable 0.6% software service fee on every single transaction. It's a fundamentally safer path.
And even in that high-stakes quick commerce war, they're being smart.
Yeah.
We discovered their operational rigor let them have the losses per order late last year while keeping the order volume.
Right. But we have to address the risks, the existential risks that have the herd so spooked.
And the biggest one is the chip choke. The U.S. export controls on advanced semiconductors like the NVIDIA H100s.
Absolutely. This forces them to rely on lower performance downgraded chips or domestic alternatives.
Which doesn't just mean higher capex. It means they have to buy and power far more chips to get the same output. It makes the entire build-out way more capital inefficient.
And that leads directly to the second risk. Investors have to accept a new normal. The days of 30% plus EBITDA margins, they're gone. Forever.
So how does this change how we value this stock? You're arguing the low PE ratio is basically meaningless.
It is. It's useless. PE measures yesterday's business. To see this arbitrage opportunity, you have to shift your framework to something like price to sales or price to cash flow.
So based on our deep dive, our verdict is clear. ACT. A strong, aggressive buy.
The market is pricing this like a dying retailer at 9 times cash-adjusted earnings.
But it's functionally operating as a hyper-growth AI infrastructure company.
The upside is uncapped AI optionality. To execute the trade, you only need to focus on 2 metrics. Cloud revenue growth.
Needs to stay above 34%.
And the stability of that customer management revenue. If they sustain that cloud growth, it forces a sum of the parts valuation. The cloud business alone could be worth nearly half the company's current market cap.
And of course, the wild card is any liquidity event for their 33% stake in Ant Group.
Yeah.
That would be the big regulatory all-clear signal.
Right. The current stock price decline, it is not a sign of failure. It's an arbitrage opportunity created by the friction of a necessary shareholder transition.
It's the old guard, the dividend seekers, selling in fear to the new guard who are looking for that generational AI growth. But remember, that future only arrives if they can navigate the chip choke.
So the final question is, which side of that trade do you want to be on?